Think you're on track to retire? Think again. Recent data shows less than 30% of us are actually ready. The game has changed, and the old rules don't work anymore. Let's talk truth.
You know, we've all been told a story. It's kind of the foundational promise of our working lives. And it goes a little something like this, right? You pay attention in school, you get the good grades, you land the career, and you work your tail off for decades. All so that one day you can finally just kick back and relax. That's the story, anyway. But for a growing number of people, well, it's a story that just isn't lining up with reality. Okay, let's just dive right into the hard truth. Recent reports have found that less than 30% of American workers are actually on track to retire at all. And even fewer believe they'll have a comfortable retirement. I mean, that is a staggering gap between the dream and the actual data. So what happened? Why does a promise that seems so certain for previous generations now feel so out of reach? Turns out there are a few massive factors at play here. We're talking everything from the house you can't afford to a stock market that isn't quite what it seems, and some broader, more powerful economic forces that are really working against us. So in this explainer, we're going to break down exactly why that story is changing. We'll start with the housing hurdle, then jump into the stock market paradox, a pretty radical theory about the end of growth, and finally, we'll cover 6 major headwinds that are slowing us all down.
So our first major roadblock is one you're probably all too familiar with: housing. Affording a home has become this monumental challenge, and it isn't just an issue for low-income workers. Nope, even high earners in big cities are struggling to get a foot on the property ladder these days.
And what's really fascinating is the data behind that feeling. Pew Research found a majority of adults aged 18 to 30 are now living back at home with their parents. And get this, the median age for a first-time homebuyer has already crept up to 34, and it's only expected to get higher. So people are buying later, and when they do, they're often buying smaller places because, it's all they can afford.
So why does this matter so much for retirement? Well, because your house is supposed to be your biggest asset. Owning it outright means you get to eliminate a huge expense, rent, in your later years. Every mortgage payment builds equity. And hey, if things get tight, you have the option to downsize and free up some cash. It's supposed to be a financial safety net. But just look at how this plays out. Let's be optimistic and say you actually buy your first home at that median age of 34. You take out a standard 30-year mortgage. Go ahead, do the math. You'll be 64 years old when you make that final payment. 64. That leaves basically no time at all between paying off your house and the traditional retirement age. It's a total financial tightrope. Okay, but what if you don't own a home? You can still invest in the stock market, right? I mean, that's the other major vehicle for funding your retirement. But here, too, the assumption of endless, easy returns, well, it might be under threat. And to really get why, we need to think about what an investment is actually supposed to do. And this is a brilliant way to think about it. Imagine you've got 10 lumberjacks. One of them saves his money, invents a table saw, and then builds 9 more for his colleagues. Suddenly, their productivity skyrockets. Now, their original quota can be met with only 9 lumberjacks. So the inventor? He gets rewarded for his productive investment with a nice, comfortable retirement funded by the new value he created. And that's the textbook definition of capital investment. It's using money to create tools, whether they're physical or digital, that make our whole economy more productive. In theory, this is exactly how the stock market is supposed to fund our retirements, by investing in companies that create real, new value. But here's the problem. When money flows into what are called non-productive assets, these are things that don't create new value, they just transfer it from one person to another. Think gold, Bitcoin, or even real estate when it's just bought to collect rent. This drives up prices without making the economy any more productive, and it diverts money away from the real innovations that could sustainably fund retirements. And there is another, even bigger issue: the overvaluation of the market itself. A key way to measure this is the price-to-earnings ratio. Historically, the S&P 500 has had a P/E ratio of about 15. That means it would take 15 years of a company's profits to pay back the cost of one share. Today, that ratio is sitting closer to 50. So what does that mean in plain English? Here's the crucial point. For the same amount of future company earnings, you have to pay 3 times more today. You literally need to save and invest 3 times as much money to get the same retirement income as someone did in the past. That makes it a fundamentally harder game to win. And this brings us to a much more profound and, frankly, kind of concerning idea. What if the incredible economic growth we've always taken for granted, what if it isn't the rule, but the exception? This is the argument put forward by an economist named Robert J. Gordon in a pretty landmark paper. Gordon's theory is that the easy, world-changing innovations have, well, they've already been made. Think about electricity, the internal combustion engine, modern sanitation. He suggests that the massive productivity gains from those inventions were a one-time event, and that future growth is going to be much, much slower. And if that wasn't bleak enough for you, Gordon also argued that this slowdown would happen at the same time as 6 major economic headwinds. These are powerful forces that will actively work against growth for the foreseeable future. So let's take a quick look at what they are. Gordon identified 6 of them, including the end of what's called the demographic dividend, stagnation in education, and rising inequality. He also points to the effects of globalization, the costs of energy and the environment, and finally, the absolutely crushing weight of debt. We're just going to focus on a few of these. Let's just zoom in on one of these for a second: rising inequality. Gordon's paper noted that while average income growth was about 1.3% per year, that growth was heavily skewed. For the top 1%, things were great. But for the other 99% of people, income growth was only about 0.75%. That's not even enough to keep up with inflation. And you can't save for retirement if your real income is actually going backward. Then you've got the 5th headwind: energy and the environment. I mean, the explosive growth of the 20th century was powered by cheap, easy-to-access fossil fuels. But they're a finite resource, and using them came at a steep environmental cost. Well, that bill is now coming due, either through regulations that slow industry or through the direct costs of climate change itself. And finally, there's the debt overhang. Households, corporations, governments, we've all taken on just staggering amounts of debt. And eventually, that debt has to be repaid. For governments, that means higher taxes. For individuals and businesses, it means less spending. And when budgets are already tight, you know what's the first thing to get cut? Those regular contributions to a retirement account. So when you put it all together, unaffordable housing, an overvalued stock market, and these powerful economic headwinds slowing future growth, it paints a pretty daunting picture. And it forces us to ask a really fundamental question. If the entire economic system that created this dream of retirement is sputtering, what story is going to replace it?